Welcome to a new weekly pre-market analysis session. Before we dive into the price action and break down the most relevant assets for the upcoming week, it is imperative to establish a framework of responsibility. Trading foreign exchange, commodities, and derivative financial products carries a high level of risk that may not be suitable for all investment profiles. Leverage can work both for you and against you. The content of this video is strictly for educational and informational purposes. Under no circumstances should it be interpreted as financial advice or a direct invitation to invest. Please remember that past performance is not a reliable indicator of future results and that you are solely responsible for your trading decisions and capital management. Trading with knowledge is the foundation of long-term success. We begin our analysis with the euro to US dollar on the weekly timeframe. Looking at the chart from a global perspective, we identify a structure that has transitioned from a capitulation phase into a clear bullish recovery. It is fundamental to note the major liquidity targets at the top, specifically the equal highs and buy-side liquidity at the 1.22 and 1.23 levels, which act as long-term price magnets. For now, the price is testing an intermediate resistance zone after a strong momentum move. This general map helps us understand that, despite minor fluctuations, the higher-tier institutional narrative is seeking upper expansion levels, as long as we maintain the structural support points that we will examine next. As we delve deeper into the current price action, we observe the pair consolidating just above a high-probability institutional demand zone. This demand zone, highlighted on the chart, serves as our primary structural support area. Note the significance of the PLW levels, or previous weekly lows, situated at 1.139 and 1.106. These act as invalidation levels for the short-term bullish bias. On the upside, price is challenging the equal highs at 1.179 and the buy-side liquidity at 1.192. Capturing this liquidity is essential to confirm whether the market has the necessary strength to pursue the 1.22 macro targets, or if, conversely, we will see a reversal toward the demand zone to collect pending orders before continuing the move. We are switching assets to analyze the British pound against the US dollar. On this weekly timeframe, we observe a highly interesting technical structure rich in liquidity levels. Following a sustained recovery from the historical lows of 2022, the price has left a trail of significant support levels. On the upside, our primary medium-term target is located at the weekly buy-side liquidity near 1.378. Further up, we have highly important historical references, such as the 2021 and 2016 highs. However, the most striking feature is the liquidity buildup on the downside. We have a series of staggered order blocks and equal lows acting as protection zones. This setup suggests a market that is building a solid base but leaving open inefficiencies that could be revisited before seeking a major expansion toward the 1.40 levels. By zooming in on pound sterling to US dollar, the market structure reveals a very defined bullish consolidation narrative. Currently, price is resting on a first level of equal lows near 1.315, serving as immediate support. However, the point of greatest technical interest lies just below, where we locate a fair value gap confluent with additional equal lows at 1.287. This market inefficiency is typically filled before the price continues its primary trend. Further down, the chain of order blocks at 1.255 and 1.209 acts as our structural safety net. The short-term target remains the capture of the buy-side liquidity at 1.378, however, we must watch for a potential liquidity run into these lower red levels to balance price before the next momentum move higher. Moving on to the US dollar to Japanese yen, the dollar against the Japanese yen, on its weekly timeframe. Before breaking down the levels, it is vital to remember that this higher hierarchy analysis is what truly guides our narrative for lower timeframes throughout the week. Without a clear macro bias, intraday entries lack a solid foundation. We observe that price has executed a turtle soup movement after reaching the BSL or buy-side liquidity zone, just below the all-time high of 162.01. The blue arrow points to a sharp rejection that suggests a shift in order flow. The immediate downside target is the shaded trading block, where institutions typically re-accumulate positions. However, if selling pressure persists, the equal lows level at 140.34 becomes the external liquidity magnet to target. This weekly map will serve as our compass for seeking high-probability setups on 1-hour or 15-minute charts. We now move on to the US dollar to Canadian dollar pair, the US dollar against the Canadian dollar. Looking at the weekly chart from a global perspective, we identify a market that has been moving within a large-scale expansive range. It is fundamental to notice how price has respected historical support structures but currently shows a bias toward liquidity capture at higher levels. In this timeframe, the long-term buy-side liquidity targets are the benchmark points that dictate the institutional order flow direction. This macro analysis is what allows us to filter out false signals on lower timeframe charts. If the weekly bias is bullish, we will prioritize seeking retracements to demand zones on the daily or 4-hour charts. Establishing this roadmap is the first step toward professional and disciplined trading throughout the entire week. Zooming in on the US dollar to Canadian dollar, the narrative becomes much clearer for our weekly trading plan. Price is currently gravitating toward the equal highs located at 1.413, with a focus on the PWH, or previous week's high, at 1.393. These levels act as short-term liquidity magnets. However, on the downside, it is crucial to monitor the 1.356 area, where equal lows and a highly relevant weekly order block converge. This is our primary support zone. Respecting this level would validate a bullish continuation toward the 1.45 and 1.46 targets identified on the macro chart. The key for the coming days will be observing how price reacts when testing these immediate highs, whether we see a sharp rejection or a solid expansion that confirms the bias we have projected. We continue our weekly analysis with the Australian dollar to US dollar pair. Looking at the chart from a macro perspective, we identify a market structure that has been operating within a complex range following a prolonged downtrend. The presence of historical liquidity levels at the top is evident, marked by previous yearly highs such as the March 2021 PWH at 0.800 and the April 2022 high at 0.766. These levels represent long-term institutional targets. On the downside, price has shown a significant reaction after testing critical support levels. Understanding this global narrative is fundamental, as it indicates the pair is attempting to build a reversal structure. Reading these major cycles allows us to anticipate whether the movements we see on daily timeframes are simple retracements or the beginning of a new expansion toward the external liquidity targets we have identified. As we dive deeper into the price action of Australian dollar to US dollar, we observe an impeccable technical validation. Notice how the blue arrow highlights the sharp rejection after sweeping liquidity below the PLW at 0.591. This institutional manipulation move captured sell stops before aggressively driving the price higher. Currently, the market has reclaimed the order block zone shaded in yellow and is challenging the equal highs at 0.690. Above, the next magnetic target is the January 2023 PWH at 0.715. As long as price remains above the new structural support of equal lows at 0.641, we will maintain a clear bullish bias. This sweep and recover setup is one of the most powerful signals we look for in weekly analysis to filter our entries on lower timeframes. We continue our advanced technical analysis with the US dollar to Swiss franc on its weekly chart. As we have been emphasizing, this deep study is the foundation that allows us to trade with confidence on lower tier charts throughout the week. In the Swiss franc, we observe a markedly bearish market structure, defined by lower highs that have strictly respected the upper equal highs at the 0.914 and 0.810 levels. Recently, price has broken through an equal lows consolidation zone with a solid expansion, confirming that the institutional order flow is fully on the sell side. The current magnetic target is of great historical importance, the PLW, or August 2011 low, located at 0.708. As long as price does not reclaim the previous supply levels, we will look for confluences on lower timeframes to follow this displacement toward the external liquidity of the previous decade. This is a clear setup that we must monitor day by day. We now move on to analyze the S&P 500 futures on the weekly timeframe, the primary barometer of U.S. equities. In this global perspective image, we can identify a perfectly defined primary uptrend structure according to Elliott Wave theory. Following the start of the expansive cycle, we observe high momentum waves 1 and 3, followed by corrective pullbacks in waves 2 and 4 that serve to balance the market. Currently, price appears to be developing its fifth expansion wave toward record levels. This macro count provides us with a strongly bullish institutional bias. As long as the wave 4 structure is not breached, our priority will be to seek buying opportunities on corrections. Understanding which phase of the major cycle we are in is key to avoid trading against the dominant trend of large investment funds. Zooming in on the current price action of the S&P 500, the precision of institutional levels becomes strikingly evident. After completing the Wave 4 correction, price has launched an aggressive expansion, leaving several fair value gaps or liquidity voids in its wake. It is crucial to observe the shaded zones, the first weekly FVG between 6,104 and 6,242 points, and a second, closer inefficiency level between 6,542 and 6,625. These levels act as dynamic support zones in the event of deep retracements. On the upside, price is challenging its all-time high or ADH near 7,050 points. This level is not just technical resistance, but the primary target to complete the fifth wave of the macro cycle. As long as price remains above the PLW at 6,814, the bias is strictly bullish, seeking external liquidity capture at newly discovered record highs. We now move on to the tech sector by analyzing Nasdaq 100 futures on the weekly chart. Much like we observed with the S&P 500, the Nasdaq presents an extremely clear and harmonic Elliott Wave structure. Following the initial major expansion, we identify the structural pivot points in waves 1, 2, 3, and the recent Wave 4 correction. Currently, the index is immersed in the development of its fifth expansive wave. This global framework is essential for our weekly orientation, as it confirms that the predominant force is bullish, driven by the innovation sector. As long as price remains respectful of the Wave 4 lows, our operational focus must center on seeking trend continuations, avoiding shorts against such a powerful and directional institutional order flow. Zooming in on the Nasdaq 100, we observe a high-precision technical structure. Currently, price is consolidating just below an equal high zone, highlighted by the blue arrow, indicating a liquidity buildup prior to a potential expansive move. On the downside, we have a well-defined fair value gap between the 23,882 and 24,423 levels, acting as our primary institutional support zone. Also, notice the PWL levels, or previous weekly lows marked with white circles, which serve as validation points to maintain our bullish bias. The final target for this Wave 5 cycle is located at the ADH, or all-time high, at 26,399 points. As long as the PLW level at 25,365 holds firm, the narrative remains one of continuation toward price discovery, providing a clear roadmap for our executions on lower timeframes. We continue our journey with the Dow Jones Industrial Average on its weekly chart. This index displays one of the most solid structures in the current market, having recently reached its ADH, or all-time high, at 49,899 points. It is fundamental to observe the dense network of institutional supports that price has built during its ascent. We have a series of staggered weekly order blocks at the 49,008, 48,090, and 47,405 levels, which serve as contract re-accumulation zones for large funds. Further down, we locate two critical fair value gaps near 44,221 and 43,078 points. These inefficiencies act as magnets in the event of a macro correction, but as long as price continues to trade above the upper blocks, our bias for the trading week will be strictly bullish. This higher hierarchy analysis confirms that order flow continues to support equities, giving us the green light to seek continuation patterns on lower timeframes. We enter the crypto asset market by analyzing Bitcoin on its weekly chart. The BTC structure is a masterful example of institutional price delivery. After reaching its ADH at $126,490, the price has initiated a rebalancing phase. It is fundamental to observe the massive fair value gap between $73,198 and $89,330. This liquidity void currently acts as the primary support where price seeks stability. Below that, we have a very solid institutional trading block between $50,253 and $60,104. On the upside, we identify a turtle soup formation near $98,127, indicating a liquidity grab prior to a correction. As long as the price continues to respect the weekly FVG, the long-term bullish structure remains intact. This macro analysis is vital for filtering out the noise of daily volatility in Bitcoin and understanding where the smart money is heading. We continue our technical analysis with Ethereum, examining its structure on the weekly chart. A critical point we must highlight is the area shaded in purple, which represents a support zone of high institutional importance. This area is not accidental. There is a powerful technical confluence between a large-scale fair value gap and several weekly order blocks situated between the $1,880 and $2,676 levels. This combination acts as a liquidity magnet where price typically finds a strong base of buyers. On the upside, we identify resistance levels at the order blocks of $3,063 and $3,400. As long as price remains trading within or above this purple band, the structure maintains its resilience. Losing this level would force us to look toward the equal lows at 1,375, but for now, the detected confluence is our primary safety net for this week's narrative. We continue our journey with Tesla on its weekly chart. The price narrative for this asset shows predominant bullish strength, having recently reached its ADH, or all-time high, at $499.64. However, following this parabolic expansion, the market has left several liquidity voids that we must monitor. We identify two immediate fair value gaps at the $473.85 and $457.75 levels, which represent the first support zones in the event of a potential pullback. Below that, we have a solid weekly order block at $430.41, followed by another block at $383.84, marking the structural safety net to maintain a buy bias. Notice the third FVG in the 357.74 area. These levels are natural magnets where price typically seeks balance before launching a new momentum move. This technical roadmap guides us to avoid chasing price at highs and instead wait for retracements to high probability zones in our lower timeframe trading. We now analyze the tech giant Nvidia on its weekly chart. The stock shows a highly aggressive price discovery structure, having recently reached a new ADH, or all-time high, at $140.76. It is vital to observe how price has left very defined internal liquidity levels during its ascent. We identify an immediate fair value gap between $115.35 and $125.60, which represents our primary area of interest for potential retracements. Below that, we have a highly relevant weekly order block at $94.88, acting as the major structural support. Note that as long as price remains above the PWH, or previous week's high at 136.20, the institutional bias remains one of full expansion. This analysis allows us to understand that, despite the verticality of the move, there are safety zones where smart money will look to re-accumulate positions if the market decides to take a breath. We now analyze Apple's stock on its weekly chart. After reaching an ADH, or all-time high, at $288.48 and consolidating below the equal highs at $280.05, the price has initiated a healthy corrective phase. It is fundamental to observe the ladder of inefficiencies and supports that lies ahead. We identify a first weekly fair value gap active at $269.94, followed by a second FVG level at $261.76 that is confluent with the current price. On the downside, we have a robust network of institutional order blocks situated at $239.93, $225.91, and $214.38, which mark our high probability re-accumulation zones. As long as price remains respectful of the structure of these blocks, the long-term bullish bias remains intact. This technical roadmap allows us to identify that Apple is seeking to balance its price delivery before attempting a new attack on its all-time highs. We continue our weekly analysis with Meta Platforms. Looking at the chart, we identify that the stock is in a corrective consolidation phase after reaching its ADH, or all-time high, at $796.85. A crucial technical detail is the formation of a LH, or lower high, at $716.50, which suggests a pause in the predominant bullish momentum. However, the support structure below is extremely robust. We have a series of staggered weekly order blocks at the $611.99, $580.82, and $555.12 levels. These blocks act as high probability zones for contract re-accumulation by institutional investors. As long as the price remains respectful of the $500 area, where we locate the major order block, the long-term bias remains constructive. This roadmap guides us to seek precision entries on lower timeframes, taking advantage of retracements toward these identified demand levels. We are switching assets to analyze Microsoft on its weekly chart. After reaching its ADH, or all-time high, at $553.74, the price has entered a corrective phase after finding resistance at an equal high zone near $500. It is fundamental to observe how the market is now seeking liquidity at lower levels. We identify immediate support at the PWH, or previous high, at $483.84, followed by a PLW level at $421.10. Below that, we have an area of great technical significance, a weekly fair value gap at $390.05, which is confluent with a historical PLW at $343.47. Despite this pullback, the presence of institutional order blocks at 513.44 and 495.93 suggests that the long-term order flow remains constructive. Our strategy for the week will consist of monitoring price reaction at these inefficiency levels to identify potential bullish reversal points. We are switching assets to analyze Amazon on its weekly chart. The stock shows a very solid bullish structure, having recently reached its ADH, or all-time high, at $258.66. Following this momentum, price has left important reference levels. Notice the PWH at $248.97, which acts as the first immediate support level after the breakout. On the downside, we have an institutional safety net well defined by two weekly order blocks at the $217.94 and $208.09 levels. These blocks represent high probability zones where institutional order flow would look to reaccumulate positions in the event of a retracement. Additionally, the PLW level at $197.74 and a historical PWH at $195.28 reinforce the asset's structural base. As long as price trades above these red levels, our bias for the trading week remains expansionary, seeking trend continuations on lower timeframes toward new price discovery. We now analyze Alphabet, Google's parent company, on its weekly chart. The stock presents one of the cleanest and most powerful structures in the entire tech sector, currently operating in a price discovery zone after reaching its ADH, or all-time high, at $342.14. Due to the aggressiveness of this latest upward momentum, price has not left any nearby order blocks. Therefore, our attention is focused exclusively on the PLW levels, or previous weekly lows. We identify a series of critical levels at $318.97, $297.00, and $269.35, which serve as our structural validation points. As long as price remains above these red levels, the institutional bias is strictly bullish. This scenario requires patience, as any retracement toward these PLW levels would represent a high probability opportunity to seek trend continuations, avoiding market entries during moments of technical overextension. We conclude today's analysis with gold, the ultimate safe haven asset, on its weekly chart. XEU/USD shows exceptional strength, operating in price discovery after reaching an impressive ADH at $5,596. It is essential to observe the institutional demand zone highlighted in purple. This weekly order block between $4,290 and $4,551 represents our major safety zone. As long as price remains above the PLW at $3,885, the narrative is one of absolute expansion. With this analysis, we finish our journey through the 25 key assets for this week. If this content has added value to your market reading, I invite you to subscribe to the channel and hit the like button. Your comments are vital for the community. Feel free to write down your questions or views, as I always respond personally. Finally, I ask you to share this video with other traders and interested parties so we can continue to grow and reach more users seeking to trade professionally. Thank you for joining me, and I'll see you in the next analysis.